Hello everyone and welcome to Fit Financials. We are here to help you take control of your financial life and become financially fit. In this video, I will let you know 5 of my favorite metrics that I look at when analyzing a stock. But before we begin, don't forget to subscribe, share, and give us a like. It really helps the channel grow, and I will appreciate you even more. As a token of appreciation, we will be giving away $1,000 worth of XRP to a random subscriber once we have reached 1,000 subscribers in this channel. To qualify, you only need to subscribe, like, and comment on one of the videos in this channel. The winner will be announced in this channel and will receive half of the XRP when we reach our goal, and the other half when they send us a video and a screenshot of their account showing they have received the deposit. If you want to get free stocks, use the link on the description below. It will take you to robinhood.com and they will give you a free stock when you sign up. At the end of this video, I will give you 2 stocks that I believe are stocks that will show exponential growth in the next couple of years. Now let's get back into this video. These are 5 of my favorite metrics to look at when I am analyzing a company finances. I would never invest in a company unless I look at PE ratio, earnings per share, PEG ratio, book value, and return on equity. The first metric that I look at is the price to earnings ratio, or PE ratio. PE is one of the most popular parameters when it comes to analyzing a stock. You can calculate the PE ratio by dividing the stock's market value per share by its earnings per share. To determine the value of a stock, an investor compares the stock's PE ratio to other stocks in the same space and industry standards, and looks at the same thing with competing companies. The higher the PE ratio, the more speculative the value in the stock is. The lower the PE ratio, the more attractive the stock is. In other words, the PE ratio shows what the market would pay for a stock of the company based on its current earnings. This helps investors determine if a stock is overvalued or undervalued. This metric helps investors determine if the current price of the stock is good enough to buy into the company. The next metric that I look at is the earnings per share, or EPS. A company's earnings per share shows how efficiently its revenue is flowing down to investors. A decreasing EPS is considered a sign of problems within the company's financials, while an increasing EPS is taken as a good sign for investors. According to Nasdaq, the higher the company's earnings per share is, the more your shares are worth, because more investors are seeking to purchase the company's stock as earnings are high. High earnings per share are usually a translation of a strong company financials. I also like to look at PEG ratio, or price to earnings growth. The PEG ratio takes the price to earnings ratio one step further by taking into consideration the growth of the company. To calculate the PEG ratio, you divide the PE ratio by 12 months of growth rate. You can estimate the future growth of a company by looking at the company's historical growth rate. A PEG ratio of over 1% is not attractive to investors, and we typically consider a stock valuable if the price to earnings growth is lower than 1%. Another good metric that I like to look at when analyzing a stock is the book to value. This method is used to analyze a stock and determine the company price to book ratio. I use this method to find high growth companies that are currently undervalued. The formula for PV ratio equals the market price of a company stock divided by its book value of equity. You can find the book value of equity by subtracting the book value of liabilities from the book value of assets. Investors view a low PV ratio as a sign that the stock is potentially undervalued, and a high PV ratio as a sign that the company is overvalued. The next metric that I look at is the ROA, or return on equity. This is one of the metrics that I use the most when I am analyzing a company. I use the return on equity to determine how well the company produces positive returns for shareholders. By analyzing the ROA, I can find companies that are profit generators. In other words, companies that put money on the bottom line. ROA is calculated by dividing the net income by average shareholders' equity. A continual increase in ROA is a good sign for investors. Those are 5 of the metrics that I use when I am analyzing a stock. But I also look at the recommendation of other analysts and compare it with my own analysis. It's always good to cross-reference information and try to see if the other analysts are looking at the same stocks in the same way that you are. Nevertheless, I always invest based on my research, and you should do the same. As sometimes you will find companies that nobody's looking at that will make you literally a ton of money. At the beginning of this video, I promised you to give you 2 stocks that I currently own and I am planning to keep for the next couple of years. These stocks are in the space of artificial intelligence, or AI, and have the potential to continue to grow at the same pace that this technology is growing, which is pretty fast. Like it or not, artificial intelligence is here to stay. So we might as well make some money out of it. The first company that I have is a California-based company that is relatively new to the space, but they already are among the best artificial intelligence companies out there. The name is Alteryx. The ticket code is AYX. This company is flying under the radar for many investors when compared with other mega cap stocks in the same space. Their software is an increasingly relevant tool for mainstream of AI. They make products that allow data scientists and analytical professionals to collaborate with each other to discover database insight and deploy new machine learning codes. I expect this stock to have a massive revenue increase in the next 5 years. In 2020, my expectation is that they will grow their revenue by at least 15% and 30% in 2021. This company is already profitable and is set to post healthy compound earnings growth of more than 40% annually over the next 5 years. This stock is definitely a must buy and is in the field that is just getting started. The next company that I have is Twilio, ticket code TWLO. Twilio is a developer platform for communications, with offices in 14 countries and counting. Their list of customers is extensive, and they include companies like Netflix, Airbnb, and Lyft, to name a few. Twilio makes cloud-based application programming interfaces, or APIs, allowing developers to build voice, video, and messaging features into their apps. Simply put, they make it easier for developers to add voice, audio, and messaging into their own apps, which sometimes they don't know how to do because they're not very well versed in the system. This company has a product that is widely popular, useful, and their services are growing very fast. Twilio's high growth means high multiples. This company was worth around $4 billion in 2008 and is now worth about $27 billion. That shows how fast this company is actually growing. Analysts are predicting profits compound to be at 45% annually over the next 5 years. Twilio also reported more than 190,000 active customers at the end of the first quarter, versus 185,000 expected. They also reported a profit for the first quarter of May 7, earning 6 cents per share, surprising analysts that have been predicting a loss of 11 cents. Their revenue grew 57% to $364.9 million. This is another great company that is outpacing many other competitors. And they're competing with giants in the field, like Amazon and Google, and they're still leaving a mark. Definitely a company to look at. If you found value on this video, please subscribe, share, and give us a like. It really helps the channel. And if you have any financial topics you would like us to cover, leave a comment in the comment section below. Make wise choices and keep your finances in check. As always, thank you and have a great rest of your day.